Oh, the market is bearish. Should I stay on the side? Has this ever crossed your mind? Hey, I'm Lily, and I'm a retiree trader. And I provide options training, especially to retirees who fear they outlive their savings, to help them to become financially independent so that they don't have to depend on their children. When we say a market is bearish, what we are saying is that we are expecting the stock prices to be dropping, just like this chart, where the highs are lower. Highs are lower, lower highs, and the lows are lower lows, lower lows. So when a stock is dropping or the price is trending down, we can either buy a put or sell a call. It really depends on what you want. So if you love the premium but not the stock because the stock is weak, therefore it's trending down, you can sell a call and collect premium upfront. But because the stock is weak, therefore it's expected to drop further, right? Because it's weak stock, it's dropping all the time. So you can expect to keep the premium you collected upfront because you do not expect the stock to bounce up. If you love the stock but not the price, because the price is too high at the resistance, you can sell the call as well and collect the premium upfront. And if you're doing this for a strong stock, be careful not to sell naked, because for strong stock, the price will retrace for a short while, and it is likely to bounce back up because the stock is strong. Therefore, with a covered call, that is, you have a long buy call position already in place, you will be safe if the stock were to bounce up above the strike price. Because if you have a covered call, you will, as a buyer, be able to exercise the call to cover your short position. If you love the stock, but you fear a crash in the stock price, and you currently have stocks on hand, what you can do is you can buy a put. Well, because when you buy a put, you're actually locking in the current high price to protect the stock in case the stock price drops down to zero. So if it does eventually drop down to zero, what you can do is you can exercise your position as a buyer, and you can release the stock to the seller at your agreed strike price, even though the current stock price may drop down to zero. You can buy a put if you want to profit from the falling price of a weak stock. Because the price of the weak stock is always falling, when you enter at the current lower high, you will benefit as well, because when the stock continues to drop, you can close the position by selling off and profiting from it. And the profit would be most likely above 100% of what you paid for the position. I hope you have learned much from this video, and if you do, please like and subscribe to my channel, and I'll see you in the next video. Bye.